Hey guys, it's Chad Larson with MLD Wealth, and this is September's Money Matters. I'm going to title this episode, We Live in Interesting Times. A lot to kind of not so much unpack, but over the last couple segments, I've brought on some keynote speakers and guests and around part of our portfolio allocation team to discuss things like international markets and equities and secondaries. So I'm not back to basics, but just wanted to kind of touch base at the what seemingly feels like the start of the year, being September. But September has always struck me as a strange time in the calendar. Ever since I was a kid, it's felt more like the true beginning of a new year, more than January 1st ever did. September meant a new school year, new experiences, new challenges, and new opportunities. This year, my wife and I just dropped our kids off at school, and it was a moment filled with both excitement and a lot of somberness. Excitement because they're stepping into their 11th and 12th grades and already looking ahead to universities, thinking about the next stage of their lives, and somberness because, frankly, they've grown up so fast. Both of my kids attend a boarding school on Vancouver Island, and here I am at 45, realizing that I'm a basically empty nester, and it feels a little strange. But it also acts as a reminder on how quickly life moves and how every season brings its own changes. In that same way, markets move through their own seasons, some filled with growth and optimism, others with challenges and uncertainty. This month, I want to share some thoughts on how we're positioning portfolios, the opportunities we see in the outlook as we head into the fall. As I start today's conversation, it's still worth reflecting that we truly do live in interesting times. Markets, like life, are always a blend of tailwinds and headwinds. Some things stay remarkably the same: human behavior, the need for resilience, the value of discipline, and yet so much around us is constantly changing. Technology, geopolitics, demographics, and how we think about health and longevity. The lesson is not to fear the change, but to be open to it, to recognize that uncertainty doesn't have to be paralyzing. It can be opportunity. What makes the difference is having a plan, having a path, and aligning yourself with people and ideas that provide real insight and experience. That's what allows us to navigate complexity, to position with purpose, and ultimately to thrive in both markets and in life. So, a little bit of an intro. Kind of some of the thematics, and I've got them titled off. The first segment we're going to talk about, that's taken on a tactical tilt within the core portfolios, is defense and aerospace. A bit of a geopolitical hedge, but it's a thematic and it's a topic I think I'm going to continue to be talking about. So let's table it. Spending has shifted from being cyclical to structural, driven by modernization programs, cybersecurity, and new military technologies. So we've seen elevated defense budgets and structural spending shifts and rising global defense expenditures. Defense spending surged to an estimated 2.7 trillion in 2024, representing a 9.4% real increase from 2023, the largest year-over-year gain since the Cold War era. Projections suggest continued expansion, with global defense budgets potentially reaching 3.6 trillion by 2032, fueled by investments in AI, drones, and advanced systems. So from cyclical to structural demand, governments are moving beyond ad hoc short-term defense allocations. Long-term modernization programs driven by cyber threats, great power competition, and the blurring of military domains point to enduring government commitments. The recent NATO pact to raise defense spending to 5% of GDP by 2035, including resilience and cyber components, highlighting the shift. So a lot of predictable cash flows, a lot of high barriers to entry. So we see contract-driven stability. So more reasons as to why we like this sector and have taken a tactical tilt. Defense companies often rely heavily on multi-year government contracts. For example, Lockheed Martin generating around 70% of its revenues from federal contracts, and Boeing's defense, space, and security being similarly dependent. Very high barriers to entry, regulatory oversight, homeland security mandates, and technical complexity create significant obstacles for new entrants, protecting incumbents and supporting durable margins. Technological innovation and diversification, innovation leadership. This isn't a legacy sector. Companies are always leading the charge in AI, electronic warfare, cybersecurity, and advanced materials. Venture capital into defense tech jumped significantly in recent years. The defense cybersecurity market alone is poised for explosive growth from around $30.5 billion in 2024 to a projected nearly $79 billion in 2033. So, diversification strategy, companies like this are expanding internationally, securing contracts in regions like the Middle East to hedge against volatility in U.S. defense spending. Geopolitical tailwinds and equity performance, how we see this playing out. The imperatives of some of the geopolitical issues, the war in Ukraine, Asia Pacific tensions, and Middle Eastern instability have prompted defense budget surges across Europe, Asia, and North America. Europe, for example, increased defense spending by roughly 17% in 2024, with Germany alone up 28%. So some of the equity upside and investor momentum, the thematic tailwinds are translating into strong equity market returns. Since April, U.S. defense and aerospace stocks in the S&P have climbed 33%, and defense ETFs like VanEck Global Defense ETF has jumped as much as 74% in this last year. Lots of tailwinds to the sector. I wanted to highlight. I think we're going to continue to see that structural shift, and it show up in the earnings and ultimately the share prices of those sectors. So it's something we're happy to have integrated into core portfolios. Again, to kind of summarize the idea of the global defense segment or trade, today the global aerospace and defense sector sits at the nexus of two megatrends: geopolitical realignment and technological innovation. As mentioned, in 2024, global defense spending surged the fastest year-over-year jump in decades, driven by investments into AI, drones, and next-gen systems. So this isn't cyclical demand, it's structural. Governments are not just reacting, they're positioning. NATO's new agreement to ramp defense and resilience to 5% of GDP by 2035 cements long-term funding horizons. So for investors, this structural spend brings a rare combination of predictable cash flows and durable competitive moats. Many defense firms, as I mentioned, derive over 70% of the revenue from long-term government contracts, and they benefit from these high barriers of entry and rising technological relevance. So add in innovation, AI, cybersecurity, electronic warfare, hypersonics, and it's a sector straddling defense and disruption. And you're starting to see that across the board. So in short, defense equities now offer both stability and growth, making them a compelling hedge amid geopolitical shifts and fundamentals that every investor should understand. The next, sector and thematic where we see, incredible, almost generational tailwinds is in healthcare innovation. Predominantly a bit of a controversial topic, but thematic as well. But it really leads into the GLP-1 market. And GLP-1, and I am, the assumption that everyone doesn't live under a rock, but what GLP is an acronym is glucose limiting peptide. So the GLP-1 market is, one of the most transformative health stories in decades. These are drugs originally developed for diabetes and obesity. By other more trade names, you'd recognize them as semaglutide or Ozempic or tirzepatide, which goes under the brand name Mounjaro or Zepbound. These GLP-1 receptor agonists have emerged as one of the most transformative medical advancements of recent decades. They have rapidly transcended their own original use case to become mainstream treatments for obesity and metabolic syndromes. Their adoption has surged in the US. Prescriptions for obesity have soared over 500% from 2019 to 2024. And by 2024, they accounted for 10.5% of all annual pharmacy claims. For investors, this marks not just a medication trend, but a secular growth theme with profound scalability and pharmaceutical companies at the forefront of capturing massive value. Analysts forecast that GLP-1 revenues could surpass 100 to 150 billion annually by early to mid 2030s. So healthcare innovation and longevity and the GLP-1 are really acting as a catalyst. I've mentioned in previous podcasts, I've gone down the rabbit hole of the not so much even the longevity trade, but in my own journey for health and and increased health span. Take me for a coffee one day, and well, I can explain some of the wild things that I've uncovered and have met some just absolutely incredible, impactful people across this trend, and I wouldn't say I'm at the forefront of it, but I know a thing or two. But I want to talk about when we talk about longevity, most people are thinking in terms of years lived, but the real measure is in health span and how many of those years are lived with vitality, mobility, and resilience. And that's where healthcare innovation is rewriting the script, and perhaps nowhere more visibly than the advent of the GLP-1 therapies. Originally developed to treat diabetes, these drugs have now become a cornerstone in tackling one of the biggest health challenges of our time, which is obesity. They're not just about weight reduction, though that's transformative in itself, considering obesity is tied to higher risks of cardiovascular disease, cancer, and reduced lifespan. The real longevity story is that GLP-1s are beginning to show benefits across cardiovascular health, kidney function, and even potential cognitive outcomes. Imagine therapies that not only help reduce weight, but also meaningfully lower the risk of heart attack, stroke, kidney failure, and perhaps even neurodegeneration. That's not incremental medicine, that's life extending innovation at scale. One of the many longevity doctors, one of the leading and longevity doctors in the space, has become a good friend of mine. And I recently gave a speech, and in the GLP-1 markets, he prescribes to his patients in microdosing some of the most fit people I've ever seen, people with six packs. But they have seen incredible data, incredible results in cognition and mitochondrial support and IGF-1 levels and glucose management. So, being off script, some of these GLPs are really starting to be introduced. And so I'm very excited about that. But, you know, the from an investment standpoint, this is one of the most compelling secular, growth stories in healthcare. As mentioned, this is a market that could exceed 100 to 150 billion annually within a decade. It's that adoption expanding past diabetes into weight management, cardiovascular prevention, and other chronic disease applications. This isn't just about one or two blockbuster drugs. It's about being positioned in a structural shift in how we manage aging, chronic disease, and longevity itself. So pharmaceutical leaders are spearheading the charge, while diversified exposure through things like ETFs capture the wider innovation landscape. Together, they offer a blend of concentrated upside and broad resilience. So perfect for portfolios looking to tap into longevity as an investable theme. So again, longevity isn't just genetics. Lifestyle, environment, access to innovation play a huge role, and GLP-1s are closing that gap between health span and lifespan. Systematic impact, as I mentioned, tackling obesity and metabolic disease has downstream benefits across every major cause of morbidity and mortality. And so pharma is that longevity engine beyond GLP-1s. The pharmaceutical industry is pushing into cell therapy, gene editing, anti-aging pathways. But the GLP-1s are that first mass market example of a therapy that could add quality years of life for millions of people. So healthcare innovation is no longer just about treating disease. It's about extending health span, compressing morbidity, and reshaping what it means to age well. So for investors aligning with these trends, it's more than chasing returns. It's about participating in the very science that will help define the next era of human longevity. So that's kind of segment two. So we've talked defense, we've talked healthcare, and getting not kicking it more old school, but more bricks and mortar or picks and shovels. I really again wanted to highlight why we remain bullish on gold. So our gold thesis is stronger than ever. Gold is not just inflation hedge; it's a cornerstone diversifier. And in this environment, we see both defensive and offensive reasons to stay overweight. So this thesis is strengthened by macro and structural trends, bullish momentum in analyst forecasts. Gold has surged dramatically in 2025, crossing 3,600 an ounce for the first time ever, with a gain of around 40% year to date. Goldman Sachs has raised its 2025 year-end target to 3,700, with a base case of 4,000 by mid-2026 and upside scenarios if strong demand continues. Even more compelling, in a stressed scenario where investor confidence in the Fed diminishes, gold could surge to over $5,000 an ounce, a level that could be triggered by as little as a 1% shift of private U.S. Treasury holdings into gold. So there is this opportunity, where we've seen, yes, gold equities have moved, but if you haven't, when we see broader flows of capital, the catch up trade is coming. And I don't mean ketchup that goes on your french fries. I mean catching up to mean value of, these are companies producing a commodity that they had budgeted in around the $2,000 to $2,500 an ounce gold range. The amount of free cash flow that these companies are generating at these levels is significant. So structural support from central banks and ETFs. Gold's rally is increasingly underpinned by structural demand, not just fleeting speculative activity. Goldman's analysts show central banks purchases adding 9% upward pressure on gold prices by year end, with growth driven by sustained buying from the official sector. ETF inflows have become a key driver as well, as investors, spurred by low rates and geopolitical uncertainty, pour fresh capital into gold funds, intensifying competition for a limited supply. Macroeconomic and geopolitical context, gold is drawing increasing interest as a safe haven asset. Amid high global debt, rising inflation, and policy uncertainty, real rates remain depressed, undermining bond appeal and boosting gold's relative attractiveness. The potential politicization of the Federal Reserve, indicated by attempts to exert influence over its independence, is causing investors to seek refuge in trusted non-sovereign assets like gold. So, a recent capital markets comment adds another angle. Even if gold appears overvalued on fundamentals, its psychological safe haven appeal plus demand as a volatility hedge justifies its high valuation. So this diversification edge in a volatile landscape, while equities gained and long duration bonds lagged, a real divergence, illustrating gold's value as a portfolio diversifier, even amid positive equity markets. Gold's performance across multiple currencies and its role as a low correlation asset makes it especially powerful weapon in uncertain environments where traditional portfolios face correlated declines. So momentum is strong, forecasts remain bullish. Two-pronged demand, central banks and ETF investors, both driving structural buying pressure, macro tailwinds, and diversification benefits, all across the way. So those kind of three things I wanted to discuss. I won't, go on, ad nauseum of how, what they would to make a call into the end of the year. I think, the Nasdaq hits an all-time high. The markets remain constructive thematically. We still see, a lot of cash on the sidelines hitting, not achieving real rates of return, more attractiveness, more capital coming back. Yes, the tariff thing is ongoing. But even since the announcement of Trump's tariffs, the S&P's up 14.4%. The fully risk on in the final 4 months for 2025. Trade news flow is just background noise and looking for stronger growth. There's no other correlation to equity prices more than earnings per share. So looking at the job market, looking at the economy as a whole, we remain bullish. Yes, we have reduced some of our exposure to some of the tech names. We've increased our exposure to international equities. Balance sheets remain robust. Loans are performing. Private credit continues to perform very well across client portfolios. And I think I wanted to kind of end things in summaries. It's in something I'm working on internally is really defining and re-refining what that value proposition is to be a private client of MLD Wealth. And buzzwords aside, MLD Wealth is where elite investors access rarefied opportunity. So a lot of the exclusive investment pathways and access to markets often reserved for some of the largest institutions, curated and differentiated access, leveraging global networks and our platform for hand selected opportunities beyond traditional stock and bond models, with a legacy focused stewardship planning not just for today, but for tomorrow's generations, and integrating impact investing and tax efficient strategies and philanthropic planning has been cornerstone. So that true multi-family office, decade long relationships, and almost all new clients by referral only. That holistic white glove service to have full service wealth planning, governance, and administrative support, for families with significant investable assets. So this is, I'm so proud of what we've accomplished. We've seen incredible growth through 2025. We've got, kind of the last quarter into the year, and, both hands on the wheel. Very excited, very proud of 2025, very excited about, the end, and really excited for what the next couple of years really shows through, the disciplined investment into our people, our process, and the philosophy of which what makes MLD great. So I'll leave that there, guys. As always, myself or any member of the team is available if you want to dive deeper into some of the thematics, and some of the positioning strategies, and or just catch up on general trends or things that we're seeing all day, every day. Have a wonderful, safe September, and we'll see you guys soon.